Hi, Bruce Miller here. Thought I'd take a few minutes of your time and tell you about what's been happening in the market for the last month. More importantly, what we expect to happen in September and into the future. But I'd be remiss if I didn't mention today, September 6th. It's been quite a day in the markets. It started out with Mario Draghi, the head of the European Bank, indicating that they were poised to write as many bonds as they need to get the European economy stimulated. And it created quite a calm in Europe and quite a positive day on the U.S. stock markets, most markets being up nearly 2% today. So it's a great day, but what happened in August? Well, August is typically a very quiet month, not much going on, not much news, and many people on vacations, very low trading volumes. However, surprisingly, the month of August is what I would call a stealth rally occurred in August, in that the Nasdaq was up nearly 5%, the S&P 500 2%, and the Dow 2% as well. Some of the commodities had rallies as well. Gold was up quite a bit, up nearly 5% in August, and that rally continues into September. And on the negative side, a commodity, oil, that was up as well. Not a great thing, but up 5% for the month of August. Oil is a troubling area. We talked about it a couple of months ago, how it was quite a positive that oil had dropped below $80 a barrel. Now it sits at $95 a barrel plus, and you will soon see your gas prices going over $4 a barrel if you haven't seen them there already. So that might create a bit of a strain on the economy into the future. But generally, August, a pretty good month. And you know what? Pretty good year in general, too. If you listen to the media reports, all the negativity, you would think we were going through quite a negative market. But in fact, most markets are up, many quite a bit this year. The S&P up over 12%, the Nasdaq up over 15%. So not too bad. But what about the future? Well, we see some opportunities, also some dangers out there. Let's start with the dangers. Right now, it looks like we have a global recession taking place. Europe is certainly mired in a recession, and China, a growth engine for the global world, is seeing a reduction in their manufacturing as well. In fact, GDP in China will probably be 6.5% to 7% this year. Not bad if you're a Western nation. We would love to have GDP growth like that. But China is used to an 8% plus type of GDP growth, and it's almost required for that economy to be sustainable. So although it's not a recession technically in China, it's certainly going to feel like they're going through a recession as that GDP drops off. Manufacturing is down here and all around the world, and I think that will have an effect on the economy going forward. Another thing I mentioned before is the price of oil. When oil came down, it seemed like we had a tax break. It spurred the economy. Spending increased on other items. At the same time, with the rise in the price of gas, it will feel like we're pinched a little bit more, and therefore consumer spending will probably go down in other areas. And to me, the most important danger that we face is the fiscal cliff. You'll hear more and more about that as we go forward, especially after the hubbub of the elections are over. But if nothing is done by Congress, and we know how intractable they've been over the last few months, several things will take effect on January 1st, which will probably throw the U.S. economy into a recession. I don't want to cover too much about the fiscal cliff now, but I would like to cover it at a future time in more detail. But there are some positives. The market really seems to react well to the thought of a financial stimulus, such as what we talked about today with Mario Draghi and the European Bank and what happened today. And the same thing could happen in the U.S. The Fed and Bernanke have indicated that they are poised to react, if necessary, with more stimulus. I, for one, am not buying that because I think that the weapons are becoming very thin that the Fed has to work with, and I think they need to keep all their ammunition for the fact that the fiscal cliff may occur in January 1st, and we're going to need everything at our disposal to lessen the effect of the fiscal cliff. However, the thought of stimulus is a great thing, and one thing I want to emphasize is that the low interest rates, they continue at historic lows, 30-year rates near 3.5%, and that's finally having a tremendously positive effect on home building, a major sector of the economy. The Home Builders Index is at 3-year highs, and builders are crying for labor because they can't get enough to keep the building going. Housing starts are up. It just seems like the low interest rates are finally starting to have a good effect in that area. So there are a lot of pluses, a lot of minuses. I personally think that we might have seen the highs for the year already, and I do think we've seen the highs for September already. However, if corporate profits continue to increase the way they are projected to, it is possible we may have a significant rally in the fourth quarter of 2012, just as we did in 2011. I know it's going to be tough. It's going to be a tough month from here on out, but Ben, we can do it, so let's go make some money.